Bajaj Electricals reported its Q2 numbers. The consumer durable segment has outperformed while the EPC segment has seen some pressure. The overall numbers were largely ahead of what the street was expecting, but their margin has contracted by over 1% compared to the same quarter last year. So we're now joined by Anuj Poddar, the executive director of the company, to talk a little bit about what's going on. Mr. Poddar, good afternoon. Thanks very much for joining in. Before we talk about the numbers, I want to just get a sense of how festive demand has been and, what you make of the trends there.
Well, I'll come back to the numbers, as you said, but I think we've had a good quarter. I think the demand seems to be bouncing back post the second wave. I would just say it is not as strong or as buoyant as it was last year in Q2 and Q3, which only means that you have to fight your way through your sales and growth. But as the numbers show, we managed to do that. So we are yet chugging along on very strong momentum.
Okay, so that's good. But, let's talk about this margin pressure because, this time a very large number of companies have spoken about this unprecedented rise in raw material prices, supply side shortages. Is that how you feel too, that, that's the major culprit? And how long do you think this is looking to last?
Well, number one, the external environment is challenging. I think there's no escaping the commodity price pressure. It is unprecedented, as you said. Had you asked me the same question 6 months ago, I would have said by now we should be seeing the fag end of it. But clearly we are not. I think we are in for continued pressure on that. That said, I was a little intrigued by earlier comment. I think we've done fairly well on margins. Actually, we've held margins. We've not dropped margins in our consumer business compared to a year ago period, Q2. And that is despite this pressure of commodities because we managed to find other cost optimizations and deliver on our margins.
Yeah, it's the EPC where your margins have dropped majorly. But so what is the plan then? You're looking at more price hikes. What's the quantum of price hikes you're looking at?
So we have been taking price hikes all through the calendar year. I think we've had between 3 and 4 rounds across most categories. The last round we had planned about a month ago, but we've decided to wait and watch to ride through the festive season, see a little more demand momentum before we take that price rise. So we are slightly behind the curve versus the cost pressure. Not all the costs have been passed on in the form of price increase. But like I said, we are calibrating the price increase. At the same time, we're finding other cost optimizations to make up for that so that we continue to deliver on our margins here.
Okay. So this double-digit margins that you spoke about is what you're targeting now over the next 2-3 years?
Yes. So, from a longer-term trajectory of our company, for those who are familiar, 2 or 3 years ago, we were a 6% EBIT margin on consumer. We had given a guidance about double-digit margin by FY23. So we're well ahead of that guidance. This year too, despite COVID, despite this commodity price pressure, we've held on to this double-digit margin, which is why I'm pretty positive about this. The one additional point I want to bring in that's really playing out for us is the cash flow and balance sheet side of the story. And that's been a phenomenal quarter for us from that perspective. In this single Q2, we've generated over 470 crores of cash flow from operations. And almost all of that is going back to repay debt. So debt has come down by 419 crores in Q2. So we are also, while we are maintaining or balancing our P&L objectives, we actually significantly strengthening.
What does the debt come down to?
It's, I think, 237 crores. It was 650 plus crores last in June 21.
So on the EPC side, when do you expect things to pick up? I mean, what's the growth outlook there?
So EPC is a structural issue. We are in the process of solving for that too. Some of that has been slower than we would have liked to have happened. But over the next few quarters, we should see a solution to that also, where we'll be out of the deep end of that issue. And we have actually been, I think last year, you compare last year Q2 to this Q2, there was a one-off reversal in last Q2. So we are comparing against a high base where you had a profit last Q2. But if you look at the sequential trajectory on EPC, we are holding firm on that. So we're not losing any more money on a P&L level. But even that money, it's an optical loss because on a cash flow basis, actually EPC is throwing up very positive cash flow for us.
What's the urban-rural contribution?
So we don't publish those figures, but our rural contribution is highest in the industry, so it's fairly strong. So our focus actually is to continue to enhance our urban share, which we've been doing successfully the last couple of years. And in terms of trend line compared to last year, when COVID happened first time round, rural was spared from that, so rural outgrew urban. But our current observation last few months is that rural and urban seem to be growing in tandem. Neither of them is really ahead of the other right now.
Okay. What are your capacity utilization levels, and what are your capex plans, if any, or are you going to hold off till we see this supply side issue sorted?
So capacity utilization is right now close to about 85%. This is for our factories, but we also, as a company, buy significantly from third-party vendors. Depending on products, because many of our products are seasonal, so the products that we're getting into season, which is water heaters, room heaters, most of them are running at 100%. But some of the off-seasonal are the ones that obviously are running at a lower capacity right now. In terms of capex, I think we have adequate production capacity between us and our suppliers. So we don't see any immediate need to be adding capex on that front.
All right, Mr. Poddar, thank you very much for joining.